So this is a completely unrelated to class material lecture or discussion. Really, it's not a lecture because I didn't really prepare anything formally. But I wanted to talk about this interesting kind of thing that's happening in the economy right now. Again, this is March 2021. And while a number of people are all focused on COVID-19 and politicians and let's see, what else would people be interested in right now? Oh, that uh, the English people, the prince and the um, woman he married, and I think they gave an interview and they got really grumpy. Well, everyone's really focused on those things. I am not. Um, I am actually more concerned about these SPACs. Let's look at these. So, SPACs are what's called a special purpose acquisition company. So, what does that mean? A special purpose acquisition company. A SPAC is basically what's called a blank check company. It's it's forming a company that has no inherent business. The only thing that the SPAC or the shell company is going to do is it's going to buy a private company and then take it public. So basically, we have two kinds of companies out there. We have private companies and public companies. Private companies don't have publicly traded shares. Public companies have publicly traded shares. Um, the private company. Now, the thing is that we don't have very many examples of large established private companies. Most companies, to grow, to become bigger, generally have to go public to get that access to the capital. There's just not a lot of examples. Um, the idea then is that, let's say I don't even have to be rich, it turns out. Let's just say I'm an ambitious young investor. Then what I would do is I would make good friends with a few lawyers and other finance people, and I would start a SPAC. Let's call it, um, I don't know, Roaring Aloha. I don't know, I'm just making it up at the top of my head. Now, the whole plan with my company called Roaring Aloha is, it's actually a pretty good name. In my Roaring Aloha company, I'm going to now take it public. I'm going to issue shares for my company, Roaring Aloha. But when someone asks me, what does my business do? What I would say is, I, Thomas Scheiding, seek out um, lucrative business opportunities in the United States 50th state. Okay, I don't know, whatever. Um, and then what I would do is I would go out there and I would try to find a young private company and I'm going to take it public. Um, hmm. Give me a second here. Um, just give me 1 second. Thinking. Actually, I don't need to think that much. I don't think I'm gonna buy Zippies. Okay, does not have shares. It's owned by some others, but it's primarily owned. I'm gonna buy it out. Um, so Roaring Aloha, the SPAC I created, is going to use all the money that it raises when it issues shares, and it's going to buy Zippies. Then, the whole intent of my company, Roaring Aloha, is that it's got a share, right? It's traded in the stock market. Now it owns Zippies, and now my company, Roaring Aloha, is going to dissolve, and it's going to be replaced by Zippies, and I, Thomas Scheiding, will have made a lot of money making that transaction occur. Now, Scheiding's idea here, I'm not the only person that has thought of this. Actually, I haven't thought of this. I'm actually just explaining how others do this. But SPACs, just since January 1st of this year, have raised $38.3 billion. Compare that to its traditional initial public offerings, which is the traditional way a company goes public, is that it just starts. So Zippies could just, ZPY, right? Ticker symbol. I'm just making it up, right? They could create their own ticker symbol and they could just start issuing shares. That way of raising money is half of what SPACs have been doing. But the more surprising thing for me is that most of the SPACs that are created haven't even identified who they would buy. So like my SPAC that I created called Roaring Aloha, maybe I already had the idea that I was going to buy Zippies. But what we're saying here is that a larger number of them don't even know what they're going to buy yet. Now, the problem with some of this would be that, these SPACs aren't making any money, right? My company, Roaring Aloha, doesn't have any revenue coming in. So it already makes it a little bit riskier. It poses a greater risk of a higher probability of failing, just simply because there's not the right incentive structure. Now, I just made up that example of Roaring Aloha, really, quite literally, as I started talking. I did not plan it out. But as crazy as my idea sounds, it's not unique. This is another one I was just looking at here, and it's called Archer Aviation. Basically, what they do, and I'll show you the picture, and then I'll go back to the slide here. There's a company called Archer, and they're going to move people around in this kind of helicopter. And it's going to fly people all around. Fly them to the airport so they can catch a flight. I don't know. Fly them around like you would take an Uber nowadays. Okay, that's the business. And you'd be like, damn, that sounds like a pretty good business idea, right? We could buy shares in that. But Archer, let's go back to the previous slide here. Archer doesn't even own a single helicopter. It has no revenue. And it's existed for a few years, 3 years here. It basically faced a choice. Does it issue shares and go the IPO route, or does it merge with a SPAC? That some other entity created a SPAC and that this would go with it. Well, that's exactly what happened. This month, the month of March 2021, Archer agreed to merge with a SPAC. And it raised $1.1 billion, valuing the entire company at $2.7 billion. Let that sink in. A business that doesn't even own that fancy helicopter, but yet is a business premised on flying people around in these helicopters. No money, no revenue, yet is valued at $2.7 billion. In fact, as you see here in the second to last bullet point, they're not even expecting to make revenue. We're not even talking about profit here. We're actually meaning that they're not going to make revenue until 2024. That's 3 years from now. And that's when that fancy helicopter will finally be approved to fly. I don't even know what to say, except for this last bullet point. They are saying, this is 2021, they are saying that by 2030, its revenue is going to go from 0, which is today, to $12 billion by 2030. As I say here in the comparison, Uber is 12 years old, and today, well, last year, it brought in about $11 billion. I'd say it's a bit optimistic, is what I'm trying to say. We've got some other examples here, too. This is just a kind of a sample of some other SPACs that are out here. These are not hard to come up with. We've got Alcuri Global Acquisition. Used to be called the ARK Investment. Not related to ARK Investment. Basically, Alcuri Global Acquisition had to change its name. And it had to change its name because it was confused with a more established company. And people thought that ARK Global Acquisition was instead the very slow-growing ARK Investment Management. No one wanted to invest in ARK Global Acquisition, so ARK had to change its name to ARK Global Acquisition had to change its name to Alcuri Global Acquisition because it wasn't hot enough. It wasn't getting the investors into it. So it changed its name. Now, what that signifies to you is that these SPACs are all about making money fast. And if something as simple as the name is stopping them from getting the money fast, they'll change their name. Now, what about this other thing called Evolve Technology? Evolve Technology is it basically scans a room full of people to see if there's like weapons or like scary things going on. But like Archer, doesn't have that technology yet. There's another SPAC out there that is raising money, and the only thing that it has is that it has an advisory council of athletes with NFL quarterback Patrick Mahomes, the Chiefs, right? Justin Verlander, Naomi Osaka. I'm guessing they're thinking that their advisory council of athletes will buy some, I'm guessing some sport-related companies, some sports-related companies. Now, if these SPACs are scary to me as an investor and as a person who's knowledgeable about financial markets, because what's happening now, which is actually going unnoticed in the same marketplace, is that bond yields are starting to rise. What does that mean? Let's kind of unpack what that means. And let's look at it this way. I am on the Wall Street Journal, and I'm going to look at the 30-year. When people say I'm going to look at the 30-year, they meaning that they're going to look at the 30-year treasuries. Look at this even here. SPAC pioneers reap the rewards after nearly 30 years. Geez, volatility hits the sizzling SPAC market. Dude, if you're not scared about SPACs after this lecture, I don't know what can scare you anymore. SPACs are scary. Sorry. I just want to find, here we go. Let's just look at this article here. Because I'm thinking there'll be a chart in here somewhere. No, really? Seriously, you're not going to give me a chart? Here we go. So this is just looking back from about a month ago. And not from about a month ago, exactly a month ago. Where and this is the 10-year treasury notes. This would be 10-year loans by the government for something else. February 9th, 1.161. Today, well, actually, let's go to March 9th, 1.596. Now, before you say, dude, that's not that big of a change. It is a big change. It's a pretty big change. Basically, what this means is that the government is continually borrowing money to finance all the stimulus. But at the same time, the government's having it's having to offer a greater incentive for people to buy the bonds in the form, that incentive being in the form of a higher interest rate, because there's an expectation among investors that the place to earn money isn't going to be in treasury notes, that they're going to make money, more money in the stock market or in SPACs. So what that means is that bond yields, interest rates are rising because the capital is becoming a bit more scarce. But what happens is that as investors think that this cash is going to become more scarce and the bond yields start to rise, you're going to get a growing number of investors that say, why the heck am I investing in SPACs? Look, did you watch Scheiding's lecture? These things are scary. Why did I buy this thing? I'm going to go back to buying a U.S. Treasury, which is not that exciting of a thing. Look at this chart. Just look at the sheer scale of what SPACs are raising. When we say raising, we mean what are investors throwing into this? They're throwing a lot of money into this. And we see that right here. Okay, I know this is not a traditional lecture, but it should give you some insight into what I'm kind of thinking about in the financial markets today. I'll also use this as an opportunity to, if anything, to promote some of my summer courses unintentionally here. But if you look, I'm offering a few summer courses. They're online. They're all in summer session 1. But the two that probably would be of interest of anyone in these courses would be, I'm offering a financial institutions course, and I'm also offering U.S. economic history. It's actually my first time offering U.S. economic history, but I'm actually kind of excited to teach it. Financial institutions, I've taught it a bunch, and obviously I used to be at the Federal Reserve, so I kind of have some things I can kind of add to it. But a lot of the lectures are going to be things of talking about things that are happening in the market as they're happening, like a SPAC.